Welcome to the channel, I'm James, and today we're looking at Roku Inc., ticker symbol Roku. They have just released their earnings that we're going to be going through right now, but as you can see, the stock is in free fall. It was down 10% on the day, and then post-market, which has only been about 30 minutes, it's down another 10% to $129 a share. A long way away from their all-time highs at about 500. It's down 69% since July. This stock has been absolutely hammered. So what we're going to do today is go through their earnings, talk about the key results, go through the balance sheet, the income statement, and the cash flow statements, and then give my fair value of the company based on these updated earnings using discounted free cash flow model and the Buffett-Graham intrinsic value. Is this stock a buy in 2022? Should you buy the dip? So let's get straight into it. Firstly, the website was down, which was a bit of a tell for investors. This was a lot of worry online, and they were worried that they were going to hide their results. But luckily, they did come out, and they came out pretty early. So firstly, before getting into it, can you please give a like on the video and subscribe if you're not already, because I will be bringing more videos daily. Let's talk about the key results. Net revenue grew 55% year over year to 2.7 billion. The platform revenue increased to 2.2 billion. Gross profit was up 74% on the year to 4.9 billion. Active accounts has reached 60 million and a net increase of almost 9 million active accounts from Q4 2020. Streaming hours up 14 billion to 73 billion. That's a lot of hours. And the average revenue per user has grown to $41.03 on a trailing month basis, up 43% year on year. It is the #1 streaming platform in the US and Canada and Mexico by hours streamed. But let's get into the numbers. Let's not get into their key points. Let's see what the numbers have to say. So if we go down, we have the 12 months ended in December 2020 and the 12 months ended in 21. Then we have the year ended. So what is the revenue coming from? Well, they've got 649 million in 2020, and it is up to 865. And then on the year, up almost $1 billion, as said before, 1.7 billion to 2.7 billion. The majority of their revenue is coming from the platform, split from 2.2 billion to about 500 million. You can see player revenue is actually down for the year, but the platform revenue has doubled. So next, what we want to be looking at is the net income. But how do you get net income? Well, we take the revenue minus all the cost of revenue, etc., 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 and that'll give us that. So what has the costs? Well, you can see the costs have increased almost $1 billion to 1.3 billion. And if we scroll down to the net income, in 2020, they were negative 17 million, and now they are positive 242 million. So that is excellent to see. Although, interestingly enough, the 3 months ended December 2020, 67 million to 23, so that is actually down, but overall on the year they are up, so that is good to see. If we just scroll down a little bit more, we can see the shares outstanding. Shares outstanding are up, which is something we don't like to see. They have diluted investors because of this. They're issuing more shares. So the always example I go to, if the company had 10 shares and you have 1, that's 10%. If they issue 10 more shares, you now have 5%. If they buy back 5 shares, then you would have had 20%. So they are diluting investors. But if they were doing this at the peak of the share price, then they were getting a very good deal. And then if they can use this to invest in more, well, to generate more revenue and profit for the company, then it's not a bad thing. So really depends case by case basis, I would say, but still overall negative that it has increased. And finally, what we're going to be looking at is the free cash flow. So to get free cash flow, we take cash flow from operating activities minus CapEx, which is here purchases of property and equipment. This is just the year ended. So the, sorry, I was reading the upline here. Net cash from operating activities is this line. It was going to be negative there. So yes, 148 million in 2020, and that is up to 228 million. And if we look at the CapEx, once again, CapEx is down 82 million to 40. So what does that give us? Well, that gives us a free cash flow of around about 202 million is what the number I've got. That isn't right. I've calculated this incorrectly. I used the top number. It's actually 180 because this is the net income at the top. So I put my sheet in incorrectly. It's not 202 million in free cash flow. It's actually 180 if I can do maths. So free cash flow is up, it's positive, but what does that mean in terms of the free cash flow statement? So firstly, what I need to do is update this number because it is not 285 at all. That is a lie. So let's quickly go to my tracker and then go to the side, and it is that number there, 202. It wasn't that number, it was 220. So let's update that straight away. 182 in the free cash flow. Now it's updated here. What do we need to do? Well, we've took the future estimates of the company based on revenues. Revenue for analysts said it'll be about 1% next year and then 26% in the following year. We've calculated a rough average here of these three numbers. I'm going to ignore 2020. So this gives us an average of about 81%. And this calculates the future free cash flows at 240 million and then increasing to $500 million in 2025. So what does this give us as a value? Well, according to discounted free cash flow model, the stock is overvalued. So I wasted my time there updating the sheet because it does not say it's a buy. $80 a share is what discounted free cash flow is saying. Now, if we look at the share price, currently only down 9% a day. The last time it was $80 a share was pretty much in the bottom of the pandemic. So I don't think that is, well, it's not a buy according to this model. The other one we like to look at is the Buffett Graham intrinsic value. This is earnings per share and expected growth rate. Analysts are expecting massive growth rates on Roku, 49%. That does seem a little bit high for me, but what we'll do is we'll have a look and see what this gives us as a value. Interestingly enough, it says it is a buy, $194 a share, which is currently at a 34% discount, slightly higher actually because it is, well, the stock has dropped. So this is with the analyst estimates of 49% in 5 years. Revenues, let's just say if it was 27%, that would actually have the stock undervalued. So somewhere between, they have to grow at around about over 40% in the next 5 years for it to be profitable at the current time. But if they do get a 50%, it could be $194 a share. I know that's probably what Cathie Wood is banking on. So discounted free cash flow model says it's not a buy. Buffett Graham intrinsic value says it is. So let's quickly have a look at some technicals to round off the video. I'm going to look at them a bit differently here because if we were to add some moving averages, what we're going to see here is pretty obvious. The price is going to be under all of the major moving averages. So we're just going to look at the 50-day for now. I normally use the 50-day, 100-day, and 200-day, but I know exactly what this is going to show us. So let's just see. Well, there is your negative point right there. I can see it already. Once it crossed under here again, that was the drop. And interesting enough, once the price got out at $402 a share, that would have been your sell signal right there. And you would have sold at 400 and not really bought all the way. So if the price goes back above, then that could be a buying opportunity. But you can see these were the telltale signs to say to sell. The stock has been consistently over the 50-day for what, post-pandemic to up till about February, about a year, and then it did drop below, rose up again, and here was the death cross of the price going under there. Then we're going to just have a look at some of the MACD as well. What is that saying? Well, it's the moving average convergence divergence, and well, a lot of negatives here. The MACD and signal line are under the zero line, which is negative, although they have crossed to the positive, that is defined by this histogram, but with these recent price movements, I'm expecting that to cross again. So that is another very bearish signal. And finally, we're going to be looking at RSI, which is the relative strength index. Is the stock in overbought, oversold regions? On the daily, trending towards oversold. And if we go weekly, that will probably tell us a similar thing. Wow, actually, that's a lot more. More oversold than during the pandemic. So that is very, very telling there. Usually after this, we've had quite a big move to the upside. You can see here, these were the last times, 2018 and 2020. So if you're gambling on that, but this is actually new lows in terms of RSI. Right, guys. Oh, just quickly as well, I want to draw attention to these price points here. This is the one I was originally going to do. This was a previous low back in August of 20. And this is the bottom of the pandemic. So if we break through this, we haven't really got any new lows that have been held till about $100 a share, and then we're really in free fall from there. So pretty scary times, I would say, ahead for Roku investors, or a great opportunity to average down. And I imagine that's what Cathie Wood's doing as well. Right, guys, thanks for watching. Please give a like on the video if you enjoyed it. Subscribe if you're not already, and I'll catch you guys next time.